Welcome one, welcome all to the Dividend Grinder. If you are new to the channel, I urge you to subscribe. I'm trying to make daily videos. I love investing, I love talking about investing, and I love getting people's thoughts and feedbacks on the investing community and finance community. What are your thoughts on certain stocks and whatnot, and what are your thoughts on my thoughts? So, without further plugging my own channel, let's get into Newell Brands. So, Newell Brands, for those who don't know, let's go into the product description. So these guys own a ton of products, and you're going to see in their description just how many they own. So right off the bat, we're starting. They have Sharpie, Papermate, Expo, Primus Sketch, Mr. Sketch, Elmer's Glue. They have, keep going down, they have HVAC systems. They have Lennox, and they have Dymo brands. Underneath baby stuff, they have Graco, Baby Jogger, Apricot, Techuena. And then we go even further down. They have Yankee Candle, Waddington, Ball, Diamond, First Alert, New, and Quickie. And then finally, they have Crockpot, Food Saver, Holmes, Mr. Coffee, Oster, Rainbow, and a bunch of other random household products that they sell. They've been around for a long time. Founded in 1903, they're in New Jersey. They were known as Newell Rubbermaid. Whoops, what a terrible line that was. Newell Rubbermaid Incorporated. So you get the point. They're in retail. They sell a lot of merchandise. So what happened? So as you can see, they were previously trending all the way in the correct direction from this typical slump of '09 when pretty much every stock was down, and they've been trending quite nicely just like every other stock. And then boom, they just hit a brick wall and went all the way down to 25. At one point, they were, if we look at the 52-week high, they were at $55. And now they've sunk all the way down to $25. Do they pay dividend? Yes, they do. And now with the price drop, it's at a 3.63% yield. So what caused this big drop? Well, their situation's a little different. It wasn't just like an earnings call and weak guidance, even though that's part of it. They decided to shake up their pretty much entire company, and they sold a lot of their product lines. So they sold Rawlings and Goody, as you see in their article, but they also sold some household names that pretty much everyone's familiar with. They sold, let's scroll up. They sell Sharpie, Elmer's Glue, and Rubbermaid, along with Graco baby strollers. So they are shedding a bunch. Rawlings and Goody are the two probably bigger brands that they're selling, but then it also includes Sharpie, Elmer's Glue, Rubbermaid, and Graco baby strollers, which are household names. So that is a big major shakeup. So unlike a lot of other companies that drop severely, like Johnson & Johnson, who had that $6 correction for their earnings, saying that, oh, you're taking this $16 billion hit, but the earnings are strong. Stuff like that, the market tends to correct itself. It doesn't need to go that low. But in the case of this, you can understand why the price drop would decrease so much. It's because they're literally shedding a big chunk of their business. And what is the reasoning? Well, I did read the article before, but let's get into it together. So if we go here, it slips 21% after lower guidance and potential asset shakeup. So obviously, when they shed pieces of their business, their margins and their profits are gonna obviously suffer, especially in the first few quarters until they can fully adjust to their business and where it's at currently. But what do they do? So from the CEO himself, they're saying, look, we believe that we're exiting our non-strategic assets. And they're essentially saying that the retail environment is fast changing. So what they want to do is they kind of want to simplify their brand, and they want to make it more advantage towards e-commerce. So basically they're saying is that, stuff like Rawlings and Elmer's and Sharpie, the stuff that they're shedding is essentially old news. It's not adapting to the current retail environment, which obviously is heading towards online. I'm pretty sure anyone with an Amazon account would tell you that. So they're kind of shaping their business to become more adaptive, which it makes sense on paper, but you just got to be careful that this doesn't come back to bite them completely, because they're going to lose a large chunk of their customers going through this. But their ideals is that if they have less products that they need to focus on, that they'll be able to just drive this company even better, have better growth opportunities because they're not scattered all over the map. and they're not spreading their company thin. Now they can focus on certain areas of the business, and now they have expansion to grow into the e-commerce, which is obviously the way that American markets are trending. So let's take a little look at their stats, because you might look at this significant price drop as I did and say, okay, obviously the first thought is there's a buying opportunity. And the other thought is, well, this could be a trap. Maybe there's a darn good reason why it got more than cut in half from its 52-week high. So let's take a look into their statistics and see what we're dealing with before the sell-off, because obviously we're not going to be able to predict. Obviously they lower their guidance, so I wouldn't expect too much, but take a look at that. Their price to earnings ratio, 9.8. That is absolutely fantastic. Earnings per share of 2.58, also fantastic for the trailing 12 months. As you can see, this is a rather large company, not huge like a couple other companies, but market cap of 12.4 billion. So it's got a decent size, as you can see by the volume. Average volume, you're trading about 8 million shares in the time frame. So it does get a lot of action. As I mentioned earlier, the current dividend yield due to the price is 3.63. It's a little elevated. And their 1-year target estimate off of these new information is $30.50. So the analysts do expect it to, recover a little from this market shakeup. As you can see going down here, their earnings anywhere from 3 to 0.9. It's been pretty stable. They have risen a lot because they acquired 2 brands in 2016 that really contributed to their growth, that they really spent a lot of money to go after, which is kind of ironic because now they're selling pieces off. So if you look at their quarterlies after the transaction happened, they've been consistently above the $3 billion in revenue. And what you also like to see is that every quarter they are getting earnings. A recommendation rating from the analysts of 2.6, not bad at all. Sometimes you got to be careful with what the analysts are saying. You can't always believe everything they say. But one thing that you do like to see in the analysts is that there is 0 votes for underperform or sell. So anytime you see that, it's usually a plus, even if it's all yellows. But there's a large majority here. You got 18, 17, 16 analysts voting on this. It's not just like 2 and they both say hold. You're getting a wide variety, and they're pretty much aiming towards a buy. So you go to the upgrades and downgrades. Well, obviously there's going to be a ton of downgrades with this announcement because the company is going downhill. So, but if you look at it, it's not necessarily horrendous downgrades. It's equal weight, equal wake, and sector perform. So it's not like they're like, oh, you sell, outperform to sell, downgrade all the way to sell. So they're pretty much saying, okay, well, now they're in line with the rest of the retail businesses, which isn't a terrible thing, but it's obviously with 3 downgrades comes a dramatic price drop, and that's why it is at its current price of $25.36. We scroll down even more, get into it more. Trailing PE 9.82, forward PE 8.96, and I'm not so certain that that includes the recent sell-off, but it actually would make sense because the price of the shares went down so much, cut in half essentially, and they could become more profitable just focusing on certain products. However, they're just going to have to, adjust it with their current revenues because their revenues are severely going to dip with the companies that they just sold off. We keep scrolling down. EBITDA of 2.52. Another terrible line. EBITDA 2.5. Wow. EBITDA 2.52 billion. Pretty strong for a company that has a $12 billion market cap. That's more than fair. We look at their balance sheet. The summarized version, $792 million in cash. Not terrible, to $11.4 billion in debt. You'd like to see that number a little bit closer, so there is a little bit cause for concern. However, they are selling off pieces of their business, so I would expect that debt number to decrease significantly and probably the cash and receivables to go up a little. So that deficit will be cut into a little, I believe, with the selling off of these pieces of their business. If we scroll down to their dividends, as you can see, their trailing dividend was 84 cents. Their forward's 92 cents. So they are increasing their dividend, which is what you like to see. And that payout ratio, that's another really good payout ratio of 32%, which means they're more than capable of paying their dividends. So What's my opinion? Is this a buy cheap or is this a trap? Well, for me personally, I would say it's a little cheap right now. Now, in the case of this, you are playing with fire a little bit because you don't know after they sell off their company, piece of their company, if they're going to be able to recover as smoothly as the CEO suggests they will, saying that it's going to be able to make them simple and, really focus on the products that they have. You can't guarantee that. There's no guarantees in the market. So with this, obviously, with every stock that you buy, there is a bit of risk. However, I think that this is definitely a potential buy. I mean, if they're selling off pieces of their company, they're obviously going to get more cash in from that sale. And then they're going to cut down a lot of their factories pretty much in half. So they're going to have a lot more cash and they're going to be a really efficient company. So I say $25 is a fair price. It hasn't been that low since like 2011 when it was like right around here. So obviously, I believe that the price is fair. I believe that the large drop in price is also fair. I think it's a little too much overdone by the market, but at the same time, I completely understand you're shedding your business. The guidance is lower from their earnings call. So I completely understand the major dip. However, with major dips come buying opportunities. I think this is one. This isn't one that I would completely go all in. Again, their dividend is pretty safe, which is why I'm making this video because I'm pretty interested in it because the dividend with a 32% payout ratio, that's really interesting. And who knows, maybe you'll get a special dividend with the sell off of some of the companies. I could definitely see that. That's almost like a REIT when they sell off some of their assets that they have to pay back to their shareholders. They don't have to do this as a normal stockholder retail, but it could happen that you can see a special dividend with these sellings. However, this was my complete video breakdown of Newell Brands. I think blah blah blah. I think I will be buying a couple shares. I do like the dividend. I like the yield. I like the payout ratio. I wouldn't be surprised if it got cut. With all these changes to their business coming, but I think there's also plenty of room for growth as well. This could be a whole new restart. And, I wouldn't be shocked if it dipped all the way down to 15. But at the same time, I wouldn't be shocked by the end of the year if we're talking this stock is 35 to 40 bucks. I could just see it rebounding nicely if their Q1, Q2, and Q3 earnings for the year look solid and on plan. This has been the Dividend Grinder. Like I said in the beginning of the video, if you're new to these videos, I urge you to subscribe. I will be trying to make these daily. Please, in the comments, list anything that you have to say about the video. Do you like this stock? Do you not like it? What are your reasons? Do you want to see me do a video on some other stock in the near future? Please, I love communicating with the fans. I read every comments. I can promise you that, and I will reply.